Refinancing your debt can save you thousands of dollars, help you pay off your loans faster, and lower your monthly payments. But refinancing at the wrong time can cost you money, increase your total interest, or even put you into a worse financial position. In today's video, we're going to break down exactly when you should refinance your debt and, just as importantly, when you should avoid it. Whether you have credit cards, personal loans, auto loans, or even a mortgage, refinancing can be a powerful tool when used correctly. But like all financial tools, it has pros and cons. So let's dive deep into how refinancing works, what the ideal conditions look like, and the warning signs that tell you to stay away. Before we get into the details, remember to subscribe to Smart Money 101, hit the like button, and turn on notifications so you don't miss any of our weekly videos on how to take control of your money. Refinancing simply means taking out a new loan to pay off an old one. The goal is usually to get better terms, such as a lower interest rate, a longer repayment period, or lower monthly payments. But refinancing can also consolidate multiple debts into one payment, making your finances more manageable. On the surface, it sounds simple. But whether refinancing is a smart move depends on several factors: interest rates, your credit score, your debt-to-income ratio, the fees involved, and how long you plan to keep that loan. Let's start with one of the most important factors: interest rates. A general rule is that refinancing becomes attractive when interest rates drop at least 1 to 2 percentage points below your existing rate. For example, if you have a personal loan at 14% and you can now refinance at 10% or even 8%, this could save you a significant amount of money over the life of the loan. However, if the rate drop is small, like from 14% to 13.5%, you may not benefit much after accounting for fees. Your credit score is the next big factor. Many people don't realize that refinancing can help you only if your credit is better today than when you originally took the loan. If your credit score has increased by 30 to 50 points or more, you're more likely to qualify for a better rate. But if your credit score is lower now, or barely improved, refinancing might offer no benefit at all. In fact, you might get a rate that is worse than your current one. So always check your credit before applying for refinancing. The better your score, the more power you have to negotiate. And remember, applying for refinancing does create a hard inquiry on your credit report, which can temporarily lower your score by a few points. It's not major, but it's something to keep in mind. Another factor to consider is your debt-to-income ratio, often called DTI. This measures how much of your monthly income goes toward paying your debt. If your DTI has improved, for example, you've paid down credit cards or increased your income, then lenders are more likely to offer you favorable terms. On the other hand, if your DTI is high, you may struggle to qualify for a good refinancing deal. Always check this number before you apply, because even one denied application can make future approvals harder. Now let's talk about the costs that come with refinancing. Many people forget that refinancing isn't free. Depending on the loan type, you may pay origination fees, application fees, closing costs, or early repayment penalties on your old loan. These fees can add up, and in some cases, they eliminate any benefit of refinancing. For example, refinancing a personal loan might cost you a few $100s in fees. Refinancing a mortgage can cost several $1,000s. So always calculate the break-even point, the moment when the money you save from a lower rate exceeds the cost of refinancing. If it takes too long to break even, refinancing may not be the best option. Let's look specifically at credit card refinancing. Many people transfer their balance to a 0% APR introductory offer, and this can be a great move, if you use it correctly. The key is to pay off as much as possible during the intro period before the regular APR kicks in. But if you use the new card to make more purchases, or if you don't pay it off in time, you could end up with more debt than before. So refinancing credit card debt only works when paired with strong discipline and a clear payoff plan. For personal loans, refinancing is most useful when your interest rate is very high, like 12%, 15%, or even 20%, and you now qualify for something significantly lower. Personal loan refinancing can also help when you want lower monthly payments to improve cash flow. But lowering your payments by extending the term means you pay interest for a longer time, which increases your total cost. So be careful with loans that offer long repayment periods. Auto loan refinancing can be worthwhile if interest rates drop or your credit improves. But be cautious. Refinancing a car loan for a longer term can put you in an upside-down position, meaning you owe more on the car than it's worth. Cars lose value quickly, so you don't want to be stuck with a loan balance that exceeds the vehicle's value. Now let's talk about the big one: mortgage refinancing. Mortgage refinancing can save homeowners tens of thousands of dollars if done at the right time. A traditional rule is to refinance when you can lower your rate by at least 1%. But again, this depends on your financial goals. If you plan to stay in your home long term, refinancing makes more sense. If you plan to move in a couple of years, you might never break even on the closing costs. Another reason people refinance mortgages is to move from an adjustable rate mortgage, or ARM, to a fixed rate mortgage. This can offer stability and protect you from rising rates. But you should avoid refinancing if you have a very small mortgage balance or if you're close to paying off your home. The closing costs might be too high to justify the change. Now let's shift gears and talk about when not to refinance your debt. You should avoid refinancing if your credit score is worse now than when you first got the loan. This will make the terms worse, not better. Another red flag is if you're planning to take on more debt soon. Lenders might see you as a higher risk, and you could get stuck with unfavorable terms. Avoid refinancing if you're close to paying off the original loan. If you only have a few payments left, refinancing resets the clock and could cost you more overall. Also avoid refinancing if you're trying to refinance debt that came from overspending but you haven't fixed the underlying habit. Refinancing won't solve overspending, it only restructures the debt. The real solution is changing financial behavior. You should also avoid refinancing when fees are too high or when the new loan extends your repayment period too much. Yes, a longer term can make monthly payments lower, but it also means you pay more interest over time. For example, taking a 5-year loan and stretching it to 8 years could add thousands of dollars in extra interest. Always run the numbers before signing anything. Another moment to avoid refinancing is when interest rates are rising fast. If you wait too long, you may miss the opportunity to lock in a good rate. Timing matters, especially with mortgages and auto loans. So how do you decide whether refinancing is right for you? Start with the math. Compare your current loan terms with the new ones. Look at the interest rate, the total interest you'll pay over the life of the loan, your monthly payment, and all fees. If the new loan clearly saves you money or helps you reach a financial goal, like paying off debt faster or improving cash flow, then refinancing makes sense. But if the savings are small or the fees are high, it's probably not worth it. You can use online refinancing calculators to help you compare options. Another important step is to think about your long-term financial goals. Are you trying to pay off debt faster? Or do you need lower monthly payments because your budget is tight? Your goals should guide your decision. Refinancing can be a game changer for some people, but it can also be a trap for others. Knowing the difference is key. And remember, lenders want your business. That means you should always shop around. Don't just take the first offer you get. Compare at least 3 lenders to make sure you're getting the best possible deal. In many cases, the difference between lenders can be huge. Finally, if you're considering refinancing because you're facing financial stress, talk to a financial advisor or credit counselor. They can help you understand whether refinancing is the right solution, or if there are better ways to manage your debt. If you found this video helpful, make sure to subscribe to Smart Money 101, like the video, and leave a comment with any questions you have about refinancing. And don't forget to check out our other videos on credit, loans, and getting out of debt. Thanks for watching, and I'll see you in the next one.